Hello and welcome what you came to see. This is the Carrier Update with the one, the only, Zach Strickland, the Sultan of Sonar. Zach, what are we starting off with?
Yeah, so it looks like we're finally seeing these tender rejection rates fall with significant weight. We are now below 17%, a 2% drop, not a 2 percentage point drop, but a 2% drop day over day yesterday. We're at 16.69%, which is the lowest value since all the way back in June of 2020 when the tender rejection index was rising extremely quickly. All the way back, I believe it's right there in that orange line there, the OTRI USA 2020 to 2021. So it's been a long time since we've seen capacity at this level, and it probably feels a lot looser out there than it has been, because think about it, Anthony, we've been above 20%, or we were above 20% for pretty much all the way from August 2020 till January-ish. I mean, we dipped below there a time or two in November and December, but into January, we were still above 20% on the tender rejection index. So 16.6% probably feels like an extremely loose environment compared to what we have been experiencing. And really the big takeaway today is it is dropping quickly. Like it is accelerated. The pattern is now, it looks like that weird January that we just came through is now over. February, it looked like we were kind of just going to slowly crawl back, because if you think about all the trend line that we had of last year, it was like this slow addition of capacity. Well, it looks like we're having January and March with the tender rejection index right now as it drops at an accelerating pace.
Yeah, and I think that's a great point that you bring up, is that this hasn't been at this level since it was on its way up. It's not like we hit a moderating trend before this. This is almost pre-pandemic, not pre-pandemic, but almost at that pre-pandemic style, because we haven't seen anything like this since before the pandemic.
Yeah, and the fact that it's accelerating, like that's the thing, is this is a 7-day moving average, so it may feel even more so from the carrier aspect, as don't rely on the spot market like you have been, is basically the lesson. You're not going to get those waterfalling tenders like you have been getting. It's still very high. Historically speaking, this is where a peak season would normally be, but in relation to where we've been, it's probably going to feel a lot different, because you cannot rely on your spot market activity to supplement some of your network, as we've seen in the past. And you can see the two, previous years here, very different experiences, dramatically different experiences in March. Hard to compare year-over-year comps, so anytime that you are reviewing those year-over-years, you're not going to be able to compare any of the previous 2 years to this current one right here. It's going to make March feel and look very different, especially when you look at those income statements and trying to derive some sort of revenue comparisons. Let's go ahead and look at the OTVI, the Outbound Tender Volume Index, to see if we're seeing any dramatic demand side declines, and we are seeing some demand side declines, but keep in mind, OTVI includes the rejected tenders, and year over year, Anthony, we're actually up in terms of accepted tender volumes in the United States right now. So take this a little bit, I don't want to say with a grain of salt, but don't take this at face value right here, because there's just more freight moving under contract right now. Again, don't rely on that spot market like you have been in the past a little bit here, but it's, last year we had a 28% tender rejection index rate. This year we're at 16.6. So it's catching up. We're not seeing the demand side fall off dramatically. It's just more freight is getting covered at a better rate. And again, those contracts, they're making it pay a lot more too.
That was going to be my next question. Kind of brings me to, hey, what's going on with contract rates? We've heard so many stories of it's just up, and that's what's really causing compliance right now.
Yeah, it's up right now. Let's go ahead and move to the next chart real quick. Tease this one out, because fuel is really, been a thing, but it did fall right back down to $95 a barrel here this morning. So fuel prices may not be as long run of a thing, but that port of Shenzhen shut down, and all the factories out there helping to drive the price of oil down. But in the meantime, I've got our retail price of fuel there in the orange line. You can see it's a little sticky. The rack price of fuel in the blue, it's coming down. It hadn't come all the way down, but the retail price, very sticky right now and very slow to react to that drop in that price of crude. So even though that price, the price of oil is dropping, rack prices of fuel haven't gone all the way down yet, and the retail price certainly hasn't gone down yet. So that's going to help inflate some of these rates, especially on the contracted side, which more freight is moving under contract right now. Yeah. The spot market tends to be an all-in rate. So
Got it, Zach. And I'm curious to see how much of this retail rate is going to be due to speculation. Thank you so much for this update. We'll check in with you again in a few moments. Right now, we're going to toss it back over to Kaylee Nix and Michael Vincent.